Hi, welcome to Insurance Insider. I'm Jeremy Hallett. Today we're going to have a conversation about entity purchase buy-sell agreements. We're going to talk today about the entity purchase, the cross purchase, and the one-way purchase. Those are the three types. Today we're going to talk mainly about the entity purchase. So first, what's a buy-sell agreement? So a buy-sell agreement is an efficient means of ensuring a smooth transition of ownership after a potentially disruptive event, which would be owner's retirement, incapacity, also disability event, and or death. And death is what we're going to be talking today about with the buy-sell agreement from an entity purchase side of things. This is actually a legally binding contract, and it establishes under what the conditions are and at what price an owner, or more often the deceased owner's heirs, must actually sell the business interest to the business entity. They don't get to negotiate on price. That's already done before this tragedy unfolded. So, under an entity purchase buy-sell agreement, the business entity agrees to buy a deceased owner's interest, and the estate agrees to sell it at an agreed-upon purchase price. Again, agreed upon, sitting around a table before this event happened with the business owners and not with the heirs of the business or the heirs of that deceased owner. So an entity purchase buy-sell agreement is almost always funded with life insurance purchased by the business on the life of each owner. And the amount of insurance approximates the purchase price for each owner's share of the business. Now, each owner actually has to agree to allow the business to purchase that specified amount of life insurance on their life, and then the business secures each owner's written consent, puts it in the file. The purchase price is either specified as a certain amount, and this is what we see often. A certain amount and every year is looked at and the values per share is reevaluated, or it's actually a formula that will be used to establish the price at the death of that business owner. Now, the business entity, that company, is the owner and the beneficiary of the policies. And when that owner dies, or if that owner dies, the business receives the life insurance proceeds, which are then used to go out and purchase the deceased owner's shares or their interest of the business. So as I'd said before, when we started this, there's actually two additional types of buy-sell agreements. The cross-purchase agreement, which specifies that each owner individually agrees to buy a portion of the deceased owner's interest. And then there's the one-way agreement, which specifies a potential buyer, which is almost always a key employee, who has agreed to buy the business interest at the event of that business owner's death. The entity agreement, though, is preferred over the cross-purchase agreement. Now, here's some reasons why it's preferred. If we can, we almost always would go with the cross-purchase agreement. When there's a bunch of owners, you would definitely want to do an entity agreement. Because under an entity agreement, the business purchases one policy for each owner. Okay. Alternatively, under that cross-purchase agreement, each owner is required to purchase a policy on every other owner. So, for example, if there's out of 3 business owners with an entity purchase, that's 3 policies. With a cross purchase, each owner has to buy a policy on the other 2. So we would have 6. So 3 turns into 6, 4 turns into 12. So entity purchase works much better when there's only 2 business owners under it. An entity agreement is also preferred when there's a wide disparity in the owner's ages. So if you've got a 70-year-old and a 30-year-old, an entity purchase works best. The business is the one, the owner and the beneficiary of the policy. It just works better that way, because under a cross purchase, then that 70-year-old has to buy a policy on the 30-year-old, inexpensive, and that 30-year-old has to buy a policy on the 70-year-old, much more expensive relatively to the pricing for that 30-year-old. So when there's a wide disparity of ages, entity agreements are also preferable. And then a business may actually choose an entity agreement to gain access to the cash value. So if this is a permanent contract, and that business owns that permanent contract, they can use that cash value as collateral to the bank to borrow money from it, to do other things, to use it to buy stuff. That permanent policy under an entity purchase is very nice. There's some benefits that are enjoyed there, because generally cash value access is not available under the cross-purchase agreement. Now, I've said this before, I will say it again. Premiums for life insurance is almost never tax deductible. Almost never. And maybe we'll get around to making a video one of these days about a 419 or one of those situations where it is tax deductible, but those are so rare. So just assume that your life insurance is not tax deductible. It's not tax deductible in this scenario either to fund the buy-sell agreement. However, those death proceeds are generally excluded from federal income tax when the notice and consent requirements have been met, which is literally almost always. So if a corporate stock redemption agreement is used, there generally is no increase in basis for the surviving owner. That corporate stock redemption, the entity purchase agreement, Because the monies come into the corporation is using it to buy those shares from the deceased owner's heirs, there's no step up in basis. Whereas in a cross purchase, there is a step up in basis because an individual is buying the shares from a different individual. And then the price for establishing that business interest in a buy-sell agreement can fix the value for the federal estate tax purposes. Okay, so as long as it's not all family members, your buy-sell agreement that you have put together will actually tell the government, will tell the IRS for estate tax purposes what the value of the business is, which is really cool. No arguing with the IRS. No one wants to do that. So, and as I'd said, this agreement, it can base that price for the buy-sell on a specified amount or a professional appraisal that uses, a formula. So those could be company's earnings history along with future earnings potential, the book value of the company assets, the general financial condition of the business, any prior sale of business interests, goodwill, the outlook for the specific industry, and even the outlook for the economy in general. All of those can be used for the formula to establish it, or you can just choose a price for it. So, a buy-sell agreement adequately funded with life insurance ends up being an invaluable tool in solving three pressing problems facing every business owner, and especially business owners with partners and families who depend upon the income from that business. Those are establishing the price for the business interest, which is extremely important, securing a buyer for the business in the event of that owner's death, and then ensuring that there's actually money there to purchase the interest when it is most needed. And choosing that type of agreement, that entity cross-purchase or one-way buy-sell agreement, depends on the characteristics of the business and that owner's wishes. I think that's probably enough for today about entity purchase, buy-sell. Looking forward to having a conversation about cross-purchase. Again, I'm Jeremy Hallett. This is Insurance Insider, and I look forward to having a conversation with you the next time. If you can, hit that like button, or better yet, leave a comment or a question, and let's keep talking about this conversation. Thank you very much. Talk to you the next time.